Welcome to InvestorHubX.com. Imagine you are driving using only a street-level road view. You can see the road directly in front of you, but you cannot see where the road is leading. Now zoom out to the city view. Suddenly you can see the bigger picture, the highways, the direction, and where everything connects together. Trading time frames work the same way. A 15-minute chart shows the small movements, but the weekly chart reveals the bigger market direction. This is the idea behind Timeframe Confluence. In this video, we will talk about the basic concept of Timeframe Confluence, why multiple timeframes matter, and how professional traders use Timeframe Confluence to improve their decision-making and trade execution. If you find this video helpful, please like the video and subscribe to the channel. This helps support the channel and allows us to continue producing more high-quality educational content. Now, let's get started. Timeframe Confluence works by combining multiple timeframes together. Traders usually begin with the higher timeframe to understand the bigger picture, such as the overall trend and major support or resistance levels. After that, they move down to lower timeframes to look for better trade entries and confirmations. This process is called top-down analysis. In simple terms, start with the big picture first, then zoom into the smaller details. You may wonder why multiple timeframes matter. The truth is, lower timeframes reveal the noise. Higher timeframes reveal the truth. Every timeframe tells a different part of the market story. A 1-minute chart captures every tick, every brief moment of panic or greed. A weekly chart reveals only the dominant forces that have moved price meaningfully over an entire week of trading. Neither view is wrong. They simply show different things. The challenge for new traders is that lower time frames are full of noise. A stock might drop sharply on a 5-minute chart, triggering what looks like a bearish breakdown, while on the daily chart it is doing nothing more than pulling back briefly within a healthy uptrend. Higher time frames, by contrast, reveal the market structure, the dominant trend, the key support and resistance levels, and the areas where significant institutional activity has taken place. Price respects weekly and monthly support zones far more consistently than it respects levels that only appear on a 15-minute chart. By combining time frames, traders achieve something neither chart could deliver on its own. They gain awareness of both the big picture and the precise detail. This combination dramatically improves trade quality, because every entry decision is made with full context. So how do professional traders layer multiple timeframes together to find stronger, more reliable setups? Timeframe Confluence works by stacking timeframes in a deliberate hierarchy. Let's use the S&P 500 as an example. Step 1. Start with the weekly timeframe. We begin with the weekly chart because higher time frames carry more weight and reveal the bigger picture. Next, we identify the key support and resistance zones. Here, the white line represents the 200-week exponential moving average. As price approaches the 200-week EMA, it immediately becomes an important area of interest. At the same time, we can also see a bullish divergence forming. When we examine the candlestick structure more closely, we notice a hammer candle, a potential sign of seller exhaustion and buying pressure returning to the market. In addition, price is also reacting around the 0.5 Fibonacci retracement level. When multiple factors align together like this, the setup becomes significantly stronger. This is what traders call an A+ trade setup. Next, we zoom into the daily time frame. On the left is the weekly time frame. On the right is the daily time frame. This area here on the weekly chart is the same area shown here on the daily chart. On the daily time frame, we can now draw the trend line like this. When price breaks above the trend line, it suggests that the daily downtrend may be coming to an end. However, a trend line breakout alone is not enough. We still need confirmation from price action. Here we can see a bullish engulfing candle, which helps confirm our bullish bias. This is Timeframe Confluence, where both the weekly and daily timeframes are aligning bullishly together. At this stage, there are two possible entries. The first entry is the breakout itself. The second entry is when price pulls back and retests the key level here before continuing higher. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, Timeframe Confluence is the process of combining multiple timeframes together to improve trade quality. Higher timeframes reveal the bigger picture, while lower timeframes help traders find better entries and confirmations. When multiple timeframes align together, traders can make more confident and higher probability trading decisions. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I will see you in the next video.